When professional day traders and institutions want the benchmark for value, they rely on one specific indicator, the volume-weighted average price, or VWAP. We are going to configure your charting software to the exact standards used by institutional desks, and then walk through 2 mechanical day trading strategies built on this metric. By the end of this tutorial, you will have a clean, distraction-free screen and a repeatable system for extracting scalping profits. Abandoning retail noise for this specific institutional metric changes your daily approach. You stop guessing on price direction entirely and start executing calculated logic based on value. Step 1 is fixing the data feeding your chart. Go into your platform settings and turn on electronic trading hours, or 24-hour market data. The VWAP calculation requires continuous volume flow. Using only standard trading hours starves the formula of data, making your entry signals inaccurate. Next, add the VWAP indicator to your chart. Most platforms add 3 lines by default. Go into the indicator settings and remove the default upper and lower bands. You should be left with a single, clear line tracking through your price action. Removing these extra bands eliminates analysis paralysis. It allows you to focus entirely on the core relationship between the current price and the day's volume. That center line represents the fair market value of your asset, based on where the most volume has been traded today. Like a rubber band, emotional momentum stretches the price far away from this fair value line, creating a massive visual gap. But anchored to total volume, the VWAP exerts a constant pull, forcing the price to eventually snap back and reconnect. We use this high-probability reconnection as our mechanical edge. It gives us a predictable target to aim for during periods of high volatility. This brings us to the separator strategy. We identify an asset that has gone parabolic, creating massive separation between the current price and the VWAP. Look to the left and mark the nearest horizontal resistance level above the current price. Never enter a trade solely on gap size. Fighting a strong trend without secondary confirmation is a fast way to lose capital. Wait for a distinct reversal candlestick with a long upper wick to print exactly at that horizontal resistance level. This triggers your short entry. Place a tight stop loss just above the candle, targeting the VWAP line below. Pairing this resistance trigger with the price's tendency to revert creates an asymmetric trade. The potential reward vastly outweighs the small defined risk. The KISS pivot activates as soon as your separator trade finishes and the price touches the VWAP. Now we observe. We are waiting to see if the market rejects the fair value line as support, rather than breaking through it. We enter the trade only when a reversal candlestick prints directly on the VWAP line, showing that buyers are stepping back in. We place our stop loss tightly beneath the VWAP and enter long, targeting the previous peak where the initial separation began. Using the VWAP as both a magnetic target and a dynamic floor allows you to capture 2 distinct profit cycles from a single market swing. You have now moved from a cluttered default chart to a professional setup using 2 precise entry triggers. Trading around strict boundaries like the VWAP keeps your stop losses tight and minimizes your exposure to heavy losses. To begin practicing these techniques with our specific stock picks and market levels, download the free gains guide in the description box below. Ultimately, achieving consistent scalping results relies on the strict execution of mechanical rules around this institutional volume data.